Hello, guys. Hi, everybody. So we're happy to be here. And today we're going to do a webinar. So we want to talk about the Avista Private Credit Fund. And we want to give you why we actually doing this, right, Mike? And we want to give you some updates, right, and what's going on and the latest developments, the deals. So we want to show you the life of the fund, right, and what's actually happening inside, right? Because it's not shared as much. That's what I feel. And that's why we're here today. So we got a special guest, Mike Sullivan. Mike, thank you very much. And Mike is one of the principals, right, at the Aspen Credit Fund, right? And he is actually working with investors, and he's going to be the one who is giving us some updates and giving us a deeper understanding of what's going on with the fund today. Mike, welcome to the webinar.
Thanks so much, Igor. Happy to be here.
Yeah, so I want to share the slides before we start. Just a 1 second. And we're going to start with the official part. So so the intro again. Mike, thank you for being here with us. We want to talk about a couple of things, the updates on the fund performance, what's going on, and then investments in the deal pipeline and future developments, right? So what is actually fund doing, and then what are we looking at for the next deals? And then we finish with Q&A. One of the questions we get, so what is that private credit fund? And in simple terms, what we want to share, it's open-ended fund focus on providing credit to commercial real estate properties. So why actually a good idea to invest in the fund right now in the current environment? And there's a couple of reasons to do that, right? One is a high current yield, because again, with the Federal Reserve lowering the interest rates, looking at the banks, looking at different options, it's it's a really good idea to be in the bank, right? And to be in a secure and safe environment. But at the same time, my personal feeling, some people saying as well, it's just a lot better. And you can look at the market and say, listen, I can do a lot better than just the banks, right? I can double probably that rate. And yes, it is a little bit more risk. Yes, there is a different structure, but at the same time, the portion of your wealth, portion of the capital, I feel like it's got to be a little bit more risky, a little bit more opportunistic and more return, right? And then it's always preferred position. When we're looking at the private credit fund, there's a couple ways you can participate in a good deal, right? You can be in equity position, which is, again, in my opinion, it's the most risky in capital stack if you're looking from that standpoint, or you could be in a position when you kind of a lender, right? When you lend in money. The one thing is good. So if you senior lender and you got the first position, meaning you're the first one going after the property, the collateral is your property. It's great, but again, so it's very minimal return. So how much you can get probably between like 5-7% right now. And when you're looking at different structures, for example, preferred equity financing, right? Or a mezzanine debt, right? Now you open yourself up for double digit return. Still safe environment, right? But it's double digit return. And I feel like it's a lot better when you get double digits and your money grows by double, right? Digits, not by a single. It's open-ended structure. It's very, I would say it's attractive from the point like you put in the money and then you wait a little bit. It's right now it's a lock period for 24 months. So, and after 24 months, if there's a choice for you, you can take the money back, right? Saying, so I'm done. Or you just keep rolling, right? And there's two different things you can do, right? You can lock yourself with distributions. You can say to yourself, listen, I want to get my distributions every month, right? I want to see it's working and I want to see my bank account actually growing, right? With distributions. Or some people say, you know what? We don't need the distributions. And that way you get a compounded interest, which is even better, right? Just a simple interest. And then a strong sponsor team. Again, Aspen Funds, it's just they have significant experience in the multifamily space and commercial, therefore in commercial real estate space, right? I want, from my standpoint, right, I want to be in multifamily, right, as much as possible. But again, you're doing the equity play, which is a little bit more risk, right? And depending on the market environment, so it's might be a lot better choice for you to be in a more secure position, right, as a lender on that. I would say quote unquote, right, as a lender on that project, right, because there's a lot of different projects right now based on the financial environment on the market, right? They don't have enough equity or they don't have enough price, right, appraisal and stuff like that. There's a lot of different opportunities. Okay, and then the lastly, it's alignment of the co-investment. So that is the fund invest personal money right into that fund, which is again, it's alignment, immediate alignment of the interest. We do actually put the money in what we do, right, every time. Diversify, lastly, it's diversify portfolio. So I just talk about that a little bit, right? So diversification, it's a factor of preservation, I think. So, and then you want to be in different structures, right, on the real estate, on commercial real estate side. Okay, so Mike, maybe you just touch a little bit on that point. So what we actually invest in, and then what type of projects, and what are the commercial real estate? So
Yeah. Well, commercial real estate obviously is a broad sector. So within that, there's a lot of different asset types that one could invest in. Specifically, what we are going after is a heavier allocation towards multifamily properties. These are, call it kind of mid-size assets where we're issuing check sizes, as you said here below, $1 to $5 million in the project itself. So that usually lends towards kind of a mid-size asset. These are, 70 to 150 doors if you're looking at multifamily. We're also focused on probably the second heaviest allocation will be industrial. We find the underlying economics from a supply and demand perspective for both multifamily and industrial kind of align with our risk profile for this fund. So those industrial assets are going to be kind of sub 250,000 square feet type of assets generally. So that'll be the heavier allocations, and then we might have kind of a smaller peppering in to blend and diversify with maybe some neighborhood retail portfolios. There might be a one-off self-storage deal here or there, but more focused on multifamily and industrial.
yeah, thank you, Mike. Thank you very much. So again, we're going to go through the target portfolio right now. As of to, and that's a question to Mike, right? As of today, just to update people. As of today, seems to be right 50, 25, 25. We're talking about pref equity or financing, and we're talking about bridge loans and mezzanine debt. So what do you think?
Yeah, we're in the first year of the fund, so it's going to take some time to hit that full blend, but we're heading towards there. So the first several positions were preferred equity. We now have some larger bridge loans that'll come in. So from a dollar standpoint, we're starting to see that blend. And then here in Q4, we'll start to see some of those mezzanine debt close. So over time, that will blend out, but more heavily allocated to preferred equity in this first year.
Yeah. And again, the reason why, and maybe I'm wrong, but so in preferred equity, there's a lot more flexibility when you can actually blend that return. When I say blend that return, so there's so many different things you can do just to actually make it a little bit higher, right? Because you can do back end, you can do front end, you can actually. So we've seen some deals, people willing to share some profits on the back end, right? So there's, small points, but again, that's the I would say needy and greedy, and then that's the advantage of the pref equity right positions, because you can be very, very flexible, I would say, right, or creative, you put it this way.
Yes.
And then, yeah, we'll move on next slide, which is a business model. And then you submit the investment. Let's say it's a day one today, right? And then 3 months after, there's a 3 month placement period when we place the capital into the projects. And then within the 24 months, you can actually, before the 24 months expiration on months was 21, I would say, right? 3 months before. You can say, you know what, I want to get my money back. So you get your money back was whatever the interest occurred that time. We're going to go through the share classes. There's 3 different classes. Like really quick, we're not going to go deeper into that. The 100,000, 6%, 70-30 split. And then we got $1 million, which is a 7% pref return. And then there's a little bit better promote and split 80-20 here. And if you want to get the 5 million or more, so there's a special terms, we can talk about that. You guys get the direct message to us, please. Let's go over to the next slide. And we want to talk about, because it's been multiple months since then, right? Since inception of the fund. So we did some updates after the first 2 months, and then it's been, was it like 4 or 5 right now? So we want to talk about latest deals inside of the fund. So what are they? So what are the, I would say, sweet things we can do, right? What are the creative financing here we use, right? To just maximize that return in general. Mike, can you take it please from here?
Yeah, of course. Yeah, this is a great asset. This is right in our backyard. So we're here located in Kansas City. This is Lee Summit, Missouri, is a sub-market of Kansas City. This property, actually, you came out and saw yourself, Igor, during your due diligence trip. So You got some firsthand experience of seeing the asset, but this is a classic value add strategy. The operator was able to assume the loan from the seller and got 2.94% fixed for 3 years remaining on the term. So they got awesome senior loan. The challenge was with this asset for them was that that loan to value for their purchase price was only 45%. So they need to bring another 55% to close the deal. So what we stepped in to do is we brought a $1.5 million check to the asset, brought up the combined LTV with our preferred equity position and the senior loan to 60%. So what that means for us is we have a huge equity cover. We got 40% in an equity cover on this asset. So say we had to take the asset over or force the sale, we could still sell at a discount and still cover our position. So we love that in this particular asset. So as you can see with the return structure here on the interest side and the fee side is we got 2% on the front end. We're getting paid every month like a mortgage in a current annual interest. And then we're accruing 6% annually, but that compounds every month. So over the 3-year term, that turns into a much higher overall yield and then a nice exit fee on the back. So, gross yield on this one's going to be, 18, 19%. So it's a really, really great asset. We'll do this type of deal all day. It's the asset itself is right in the path of progress, Class A development happening all around it. So it's a classic value add play.
Yeah. Yeah. Thank you, Mike. So, and I just want to do one more time right into the numbers real quick. One number, right? 1.5 million. So the smaller amount inside of the property, like inside of that deal, gives the chance to be in secure position from the standpoint there's so much LTV like on top of like there's so much equity right on top of it. So you do really feel comfortable right inside of that deal. That's one.
100%.
Yeah. Thank you, Mike. And then the second, people are asking, where do you get those money from? Where's that 14% from? Like 14, they saying 15. But now you just combine all of those numbers, 2 plus 8 plus 6 plus 1. So this is a pretty juicy deal, right? Speaking of the debt position standpoint, right? You're not in a position of equity, you're in a position on debt, right? And I would probably be in that all day long, like you said, right? I will take it every time because you got like a high double-digit return in the debt type of environment, right? And so we want to move to the second one. Mike, if you can update us on that one, and it's a little bit different. It's not multifamily this time, right?
Yeah, this is another great asset. So this is Waycross, Georgia. Kind of a strategic location. It's halfway between Jacksonville, Florida, and Atlanta, Georgia. So great strategic location, right on the main kind of interstate there. So it's definitely a kind of a logistics hub in that sense. Mm-hmm. So this particular buyer that bought the asset that we lent out to is a really seasoned operator. They are very dialed in with this asset class. They have tons of full cycle deals, very experienced. So we've been wanting to do some work with them, and came across this great deal. So this is a Class A industrial property. This was owner occupied. So the tenant was the property owner. They built it to suit, and they outgrew the space and needed to relocate to a larger space. And as a result, they needed to close quickly. So this particular buyer, whom we're working with, bought it 30% below the replacement cost. So they got a huge discount, and it's a really simple strategy. It's come in and, white box it and basically use the capital to not only acquire the asset, but have enough working capital to negotiate the tenant improvements, and kind of white box the asset and get it leased and sold. So it's a shorter cycle. They actually had, kind of latest updates on this one. We closed on this here in the summer. They're already looking like they've got some pretty serious leasing interest in it. But from a structure standpoint, we brought a $2.1 million check size here. So combined with the senior, we've got a 75% loan to value. And so we got the same thing here. We still have a nice equity cover. This is 25% equity cover on top of our position. We also negotiated. Not only do we typically are going to have for sale rights, but in addition to that, we also negotiated takeover rights. So we are added into the management company that owns the asset and operates the asset. As a result of those takeover rights, if there's any default, then we can actually take the asset over, take over management of the asset, and ultimately kind of dictate what are the steps that need to be taken. So we have some nice rights here, and as you can see, we've got an origination fee on the front end. They're paying us 5% current, so that's paid every month, and then we've got a nice 10.5 that's accrued and compounding annually with a 2% exit fee. So this is kind of shorter cycle type of deal, which again we love this. Their track record is excellent, and one that we would do all day.
Yeah, that's a great deal. I feel like that. So not just feel like that, just numbers say that as well. I think there's what I was about to say, because I think I got a really good point here. Yeah, the takeover rights. Yeah, that's what I was about to say. So the Aspen funds, they manage the properties as well. So which is in their in their backyard, right, in Kansas City. So if they need to take over something, there's a lot of expertise, right? And there's a lot of things they can do to pull some strings to make it even better property, right? If they take over this thing. And that's why we got a lot of confidence when we get takeover rights. It's not going to be just as this, it's going to become even better because of all that experience, right, of the years of managing different assets, though, and the team behind that for sure. So we're going to go to slide number 3, right? And Mike, can you give us some updates on that one?
Yeah, of course. This is a great deal. So this is Atlanta, Georgia market. So obviously, you're right, they're in the Sun Belt. This particular asset was truly just a mismanaged asset. The lender actually took the property over and awarded it to the buyer, whom we're lending to. So this was, a distressed asset that got kind of flushed out of the market. The lender actually kind of dictated how this would go, and so they awarded it to a very seasoned operator. Same kind of story with the prior, is that they've got a deep track record, tons of full cycle deals, very multifamily. They're vertically integrated with multifamily. They've got all their stuff in house, and they've got a big presence in this market. So that was part of why it was awarded. The lender reduced their basis, which made way for them to buy this at the right level. So we negotiated takeover rights and forced sale rights in this asset as well. We brought $1.7 million to the table. So with the lender's position and ours, combined LTV at 70%. So we got again another nice 30% equity cover here. Yeah. Getting a nice fee structure here with 6% accrued interest, 10% accrued and compounded annually. So we did negotiate a 1-year extension because it's multifamily and they're doing some value add with this property. They need to have a little flexibility in here, but basically simple strategy. They've already got this thing back and humming. So kind of the previous operator before they purchased it just really mismanaged the property. They had it. I mean, it dropped, I think, below 80% occupancy. They were not turning units. They were not renovating, which was part of why the lender stepped in. Mm-hmm. So they've got this property fully back on track. It's already performing. So far, the business plan at the asset level is doing quite well.
Yeah. And again, that's for listeners again, Mike, question here. So why would they go just the regular route, go into like conventional bank, right, and loan? Why they cannot do it in this case?
There's really no options. I mean, commercial works differently. I mean, if a bank already has a senior position, no other bank is going to come in to a second position. And so this is not a new sector of the industry in any way. What we found is as credit has tightened with banks and their lending, criteria has shifted, their LTVs have dropped. It's creating this gap for funding needs. So this particular buyer needed working capital to continue to do their value add. In addition to that, this helps because our returns get capped. Although it's not cheap money, it's still capped. And so when you have an equity driven deal, all of that leverage ratio is accretive to investor returns. So because they may make 25% on the back end, and we're out once we've hit our 18, 19%, all of that return can kind of get blended out through the rest to the rest of their investors. So that's why they would do that, is they're levering up, by using us. They're getting a higher overall, and we can bring a single check to the table that allows them to purchase the property and have all the working capital they need.
Yeah, thank you, Mike. That's a great point. And then I'm gonna double down on one thing. So there's sometimes a speed, like which is the speed to the market issue, right? We want to do this right now. Why right now? Because tenant will sign a lease immediately, right? And if we're not doing this, tenant is gone, right? And then that big
Right.
box without a tenant worth like zero, like almost nothing, right? When we got a lease for
Yep.
10 years in place and it's predictable income, so that's worth like a lot more than that. So that's one. The second one, if you look at the structure, they only paying 2% origination fee plus 6% current. So the 2%, it's a one-time payment. And then 6%, that's what you're going to incur like month over month over month. And then if it's like Mike said, if it's equity play, if it's equity driven play, I mean, they're going to share that all day long. Why? Because they know they're going to make a lot more money on the back end. But to execute that business plan, you need the money, right? You need the cash flow, you need the gas, right, to execute that business. So
Right.
basically, that's why it all works. And that's why the market created that opportunity for the private credit fund. And then the private credit fund has an ability to do it fast, right? To do it creative, right? Because you come to the conventional bank and they say, okay, yeah, wait for 3 months in the line, right? And then there's no assurance you're going to get that loan, right? You could say, okay, so we're not doing this. Why? Because of you don't have this comma, you don't have this, print here. I mean, there's weird things they don't give you money for, right? Because they tied it. They just tied that whole credit market. So that's one. The second one again. So you could be so creative, right? You will find a way to finance them because they such a the equity driven on the backhand, right? And they're willing to share with you some profits. So I'm going to go to slide number 4. And I haven't seen that deal, so it's very interesting. I want to hear that about. Is it the land development? Is it land play? So they just building something?
Yeah, this is Class A multifamily in Bentonville, Arkansas, which is one of the hottest markets in the country
Mm-mm.
from a rent growth perspective. I mean, tons of actually California transplants coming to the area. So this is where Walmart is headquartered. The nature of kind of Walmart is that they require their vendors to actually have physical locations in Bentonville. So as a result, it's just created a ton of economic development, a ton of uh, a ton of demand, but just very few, very little inventory
Yeah.
of housing and housing units. So development has been on a tear there in single family. It's been on a tear in multifamily. We've got assets already in this market on the equity side that we're holding that are doing quite well. So this is partnering with another developer that we know. It's a family owned developer in this area who've been developing for decades. So
Mm-hmm.
fantastic track record. And so this is yeah, the land's already entitled. They're getting going on getting the ground up here. So they needed some gap funding to get this done. So we stepped in to give them $3.3 million to help them take down the land and get going on construction. So we provided them a loan to cost. So this is 66% loan to cost. So we have full takeover rights. We have for sale rights in this asset. Again, we already have assets that we manage in this area. But this is a beautiful part of the market. Bentonville has become, a very hot location, and Walmart's like building a brand new headquarters that's just incredible. And so this is not far from the headquarters. So a lot more housing units are going to be needed as they kind of continue to experience population growth. So it's a kind of perfect market conditions, perfect timing, seasoned operator. We know the operators personally. We know them quite well, and we know this market very well. And so this is one where, development is certainly something you need to be, careful in the allocation towards, which is why we have other value add versus, different strategies. But this is one where there's going to be uh, a really nice equity kicker also that we've negotiated here. So that's kind of the unique thing, because we're going to get a nice sale on this land, and we're getting 0.5% on the sale. So that equity kicker turns this total yield into, potentially 20 plus. So we're quite excited about it.
Yeah. I was about to point that as well. So that is an example, right, of how you can just maximize the position right inside of the real estate deal, and be willing to share some profits on the back end. And that's kicker. That's huge, right? If they're doing the really good job, they've been experienced, like they're doing this for the last 20 years, right? They've been doing like project after project after project, and it's successful. So that's going to be a really huge, right, for a fund itself. So thank you, right? This is what we have so far. into the fund. I would not what we have so far. Sorry. So this is what we got for the last couple months, right? This is the most recent updates. And then we want to talk about the future development, like what's actually in the pipeline right now. So, and where we actually going as a fund. So what are the deals coming out right into the market?
Yeah, so I mean, no shortage of deal supply. So a lot of continued. I mean, multifamily and industrial are the kind of again key focuses there. We just closed on a little neighborhood retail. Actually, that 400 million right there is a 400K. We just closed on that one, so we can get you some updates there. But that just came through. That was a mezz loan. Um, but yeah, tons of deals coming from all over the country, really, and no shortage of supply. So, kind of the thesis is playing out. I mean, we're already seeing from this quarter everything is tracking at kind of parent fund level. The gross yield is in that kind of 18-19%. So we're seeing really strong yield, and ultimately that boils down to consistent cash flow for our investors. And there's no end in sight. So we're really limited only by the amount of capital that we can bring to the table. So nice, Igor. That's perfect.
I just made it immediate change so the people will not be confused.
Love it.
A million.
Yeah.
Yeah.
Yeah. Sorry for the confusion there, but yeah, it's we feel strong about this and doing another big push here this quarter. Kind of one thing I'll draw to the attention to everyone really is that because we're also a little more heavily allocated to preferred equity, we've negotiated all these deals to participate in the depreciation. So we will be passing through some depreciation to all the investors. So this will be kind of the 1 year where that sum is going to be a little more meaningful compared to future years where that depreciation will get blended out amongst more mezz loans and more bridge loans, and so the impact of that will get spread out. But that's definitely something to highlight here. So, in talking with our asset management team here, there's I think we've got 4 or 5 deals already working through underwriting that we feel really solid about that we can close on in the near future, and even more that are kind of in the underwriting phase where it's a pretty time consuming endeavor just to go through and do the deep dive to dig through all that's needed to underwrite, do due diligence on the operators,
Absolutely.
market, all those things. So it's not necessarily a short process, but we definitely have a lot in the pipeline.
Yeah, absolutely. So, and I just want to add something, right? Because you're in the space of acquiring and constantly looking through the deals, um, so many people, right? And deals are coming up to you, right? Because once you start to say we do have a private credit fund, people are like, oh, okay, we need some gap funding here. So, what do you want to ask? Oh, let's ask Mike, right? They got Aspen funds. Let's ask them. So they do have a credit fund. So, and because of that cycle, right, and the closed cycle of different deals going around. So it's always a pipeline of different offerings, right? And very interesting things happening on the market. And yes, they do leverage the network on that sense, right? Because people know you on the market as a strong player, and they always come and say, "So what do you guys have? So can we get a finance and can we do this? Can you help us with that?" So and what another, I think not what, but another really good thing. So the commercial real estate space is such a different animal from the single family, for example, investments, because everybody trying to help everybody, right? And then they just throw it out there. It's like, how can we get financing? How can we get a new deal? You guys have somebody in Georgia, right? You have somebody in Florida. So it's super helpful environment in general. So there's never a shortage of what I'm trying to say is, so there's never shortage of the good deals. I mean, good deals shortage, but there's never shortage of the deals, right? In general. And you need to spend a lot of time analyzing and really going through the numbers and if it makes sense. So just fund it. So if you guys have questions, please let me get my screen rolled over to the next slide now. I am just stuck a little bit. I'm officially stuck. Why? Because sorry guys. Click on that. Yeah. No, yeah, because I grabbed that pen and it's still on that pen section. So anyway, to answer your question, so it's going to be in Q&A section down below, and we'll be happy to answer those. So Regina, can you help us out? So do we have any questions so far?
Yes, we do have questions. The
Mhm.
first question is, do the people get the capital call in the deal right now?
So you're talking about the equity probably, right? Play. So I think we can ask Mike from his experience if people, I think that's a question from the equity investment standpoint. So do you hear on the market people are getting the capital calls and they stop, like the operators will stop distributions in
Oh,
this case? Do you see that on the
yeah.
market still happening?
Yeah, for sure. I mean, I think we've seen, a large amount of distress that's happened in the marketplace over the last, year in particular, and kind of continuing into 2025. The reason for that is a lot of operators have bought multifamily in particular on bridge loans. And as we had kind of unprecedented increases in interest rates, that's created a lot of distress in a valuation of with the valuation of the property. So they have a basis issue. And so as a result, there's been a lot of capital calls this year to try and kind of rescue deals and buy rate caps, kind of kick the can down the road as much as possible until hopefully that interest rates would come down. So we're starting to see, obviously, we've had a decrease here recently, and
Mhm.
indications that those will kind of continue to come down, but they're nowhere near where people are purchasing these properties. So they're overpaying because they could, because interest rates are so low, and it allowed for the cap rates to compress to where they could still cash flow. But if you have any significant change in the interest rate, then all of that goes kind of out the door. So definitely a lot of capital calls happening these days. We ourselves are not really investing into through this fund. We're not investing into any distressed assets. We're kind of letting that flesh out in the market, similar to what you saw with that Atlanta deal. Let it kind of flesh out, and then we'll be there on the back end uh, to get in with the reset of the basis.
Gotcha. Yeah, that's a good point. So reset of the basis, like crucial right now at the market. So I have my own question, right? Because a lot of times when you start to approach investors and you say, "Here's what we got," so we got private credit fund. They compare because of the return, and again, so it's just a simple comparison, number to number, right? They say, "So I am in the hard money loans." So I am in the hard money loans. We're getting the same return. Why would you switch from hard money loans? And you can actually redeem within the months or 2 months, right? Or maybe 3 months, the longest. And it's comparable, right? They probably like get about 10% or so. So why would you do that instead?
Yeah, I think a lot of people underestimate their exposure from a risk-adjusted return perspective. So hard money is certainly a piece of the portfolio. We do it ourselves in our funds as well. Um, but you have a lot of concentrated from an investor's perspective. If I've got, somebody that I just threw $100,000 or $200,000, 300, whatever it is, into a single asset, you have a ton of exposure into a single asset that, particularly with hard money, if you're not in a position to take the asset over and actually see that through to completion, can be a lot of exposure of risk to you. And then the total yield is again in that similar range. So I would say it's just a piece of the puzzle. This is a diversification play. You have way more diversification through a fund because it's going to have not only assets it's purchased today, but it's going to purchase more in the future. And so that blends your exposure to any one asset compared to tying up $300,000 in a hard money loan. So it just comes down to risk and return. In this case, because of our position and because of the grade of these properties, the experience of the operators that we're vetting, we find the risk adjusted returns to be much stronger. Uh, and we can demand more at the end of the day because there's not as many options for the operators. So that's why we're able to create these, pretty significant 18, 19% gross yields and then blend through the expenses, just blend that down into consistent returns for investors.
Yeah, I think it's a great point, right? So speaking of exposure and so you one-off thing. So if something goes wrong, all of your capital basically exposed to certain adjustments. I would put it this way. So, but then whether you're in the fund, right, it's a different story, right? You allocate it between different assets, and it's a commercial real estate. It's a lot larger, and having that small portion between 1 to 5 million into that big commercial asset, right? So that gives you another peace of mind. So that's pretty secure. That's pretty good position to be somewhere in the middle of the capital stack. I don't know if you guys realize that capital stack from top to the bottom, right? But there's a senior debt, which is the most secured. And then, so we come right after that, right? And then we want to be there. Why? Because it's a lot more return. So you don't want to be on the senior debt. I mean, you do, but not at the whole, you know, all costs, right? All capital. So because of that middle position, there's certain piece of security from the top, and there's a lot of potential on a return. You can get a lot more money, right, on being in the middle. So yeah, I think we're gonna stop here because it's getting a little bit over 40 minutes, and I feel like it's might be tiring for people to watch that through. So if you guys do have a questions, right, if you do have some more questions, please reach out to us for next steps. If you guys want to invest, if you're curious, if you got more things to ask, please reach out to our relationship teams, right? It's going to be invest@avistafund.com. Once again, it's invest@avistafund.com. You can always go to the website and fill out the form as well. Um, I'm going to say thank you very much, Mike, for joining us, right? And that's great updates. I feel like the fund is doing really, really well. And if you want to say something for closure.
No, well, great to be partnered with you. We love your team. We love working with you guys, and excited for future gains together.
Yeah. Thank you, guys. Thank you very much, right? We're going to stop here and I'll see you later. I'm going to end right now. End the webinar.